how the health of the Indian banking system is shaping up in the wake of what we're seeing globally, given that with rising rates, there's been benefit on account of net interest margins, but for how long can that trickle down to the bottom line?
Thanks, Tanveer. Thanks for having me on the show. So indeed, Indian banks have been on investors' mind, given a bit of underperformance that we've seen over the last couple of months. And clearly the reasons were quite a few, one of which you mentioned, and that is the normalization of the margins, because last year was pretty good from the margin standpoint as the Reserve Bank of India was raising interest rates. We believe that Indian banks are at an inflection point, given the underperformance that we've seen. We believe that the normalization of margins, which has been underway for the last 1 or 2 quarters, will start to bottom out over the next 2-3 quarters. And loan growth, which has already moderated from 16% plus to now about less than 15%, also to some degree has already been reflected in the numbers. We believe that over the next 2 quarters, the normalization trends would play out. And given the fact that banks have underperformed significantly over the last couple of quarters to the extent of as much as 30%, there is a value that has emerged in Indian banks. So we see that as an opportunity to buy into these banks, and therefore we are quite constructive on the sector.
Right. I also want to take up a question on non-banking financial institutions, the shadow banking sector, because obviously because of rising rates, there's much concern about the risk of delinquencies, given that they're not backed by regulations of the central bank. They're not under regulatory oversight. How do you look at that sector's health at this stage?
Sure. Great question. So just as a matter of fact, our preference has always been about favoring banks over NBFCs for a variety of reasons. And I'll come to that in a bit. But to answer your question, I think the RBI's regulations have improved and become tighter for the NBFCs over the last couple of years. And so much so that the regulatory arbitrage that existed between banks and NBFCs have actually narrowed. So from that standpoint, we believe that NBFCs are now well regulated, and the regulatory arbitrage has to some degree gone away. But the reason why we prefer banks over NBFCs stems from 2 or 3 simple facts. One is from the liquidity standpoint, and that has been on top of RBI's mind. I think NBFCs fare much lesser than banks because they rely for their funding need for more than 50% from the banking system. Number 2, banks have become more and more competitive. So they are taking competition to the turfs of NBFCs, particularly in the consumer lending. And number 3, given the fact that the valuation differential has come down between these 2 segments, we believe that there is more value in the banking names than the NBFC names.